If you look at almost any complex field in human history, there's a very simple linear rule, and that is, if you're smart, you have a better chance of making it in that field. If you want to be a grandmaster chess player, a theoretical physicist, or a neurosurgeon, raw processing power matters. A higher IQ correlates to a higher probability of success. And it makes sense. Better logic, faster pattern recognition, better memory. These are the tools you use to solve problems. But there's one place on Earth where this rule doesn't just stop working. It actually reverses. Welcome to the financial markets. The only place where a PhD in mathematics can be outperformed by a random number generator. It sounds like a joke, or something failed traders say to make themselves feel better. But it is a statistical reality. And we don't have to guess about this because in the late 1980s, a group of the smartest people on the planet actually tried to prove us wrong. The Mensa Experiment. You probably should have heard of Mensa, but if you haven't, it's the International High IQ Society. To get in, you need to score in the top 2% of the general population on a standardized intelligence test. Basically, these are the people with the Ferraris of human brains. 15 years ago, an article in Smart Money magazine tracked the performance of an investment club composed entirely of Mensa members. The theory was simple. If trading is about processing information, analyzing charts, and understanding global macroeconomics, then a room full of geniuses should be unstoppable. They should be able to see the matrix, right? So, how did they do? Over a 15-year period, the S&P 500 returned an average of about 15% per year. The Mensa Investment Club, they returned just 2.5% annually. They underperformed the dumb market index by almost 13% every single year. Think about that for a second. If they had just put their money in a box and forgotten about it, they would have been rich. Instead, they used their superior intellect to lose money. Warren Buffett actually summed this up perfectly. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. So, why does this happen? Why is intelligence a liability? To answer that, we have to look at the father of science himself, a man who defined intelligence for the human race, and then lost his entire fortune because of it. Spring, 1720, in London. Sir Isaac Newton is at the height of his powers. He has defined gravity, invented calculus, and unraveled the nature of light. He is, effectively, the smartest man alive. He's a man who demands order. He spent his life proving that the universe follows strict, predictable laws. So, when he looks at the stock market, he assumes it must follow laws too. The hot stock of the day was the South Sea Company. On paper, this company had a monopoly on trade with Spanish South America. But in reality, the company was a shell. It was a financial engineering scheme designed to take on the British government's debt. It was complex. It was risky. And Newton knew this. Newton wasn't a gambler. He analyzed the situation. He bought in early, sensing the public interest. The stock rose. He sold his shares and pocketed £7,000, a massive fortune at the time. He analyzed the system, extracted value, and exited. This was the behavior of a rational, intelligent man. But the market didn't stop. In the spring and summer of 1720, the South Sea stock defied gravity. It went from £130 to £300, then £500, then £800. Society started to unravel. Dukes were trading with dustmen. Ladies were selling their jewelry to buy shares. And Sir Newton was watching. Imagine the psychological torture. This was a man who understood the math. He knew the valuation made no sense. But every day he walked outside, he saw people he considered intellectually inferior getting rich. His friends were buying carriages, they were buying estates, and they were looking at him, the great Sir Isaac Newton, and asking, "Why did you sell so early? Don't you understand the new paradigm?" This triggered a flaw that intelligence cannot protect you from. The pain of being out became greater than the fear of losing. So, near the very top of the bubble, the man who invented calculus went back in. And he went back in big. The bubble burst almost immediately. Newton panicked, but still held on, hoping for a bounce, and eventually sold at a catastrophic loss. He lost £20,000. That was his entire life's fortune. He died a wealthy man only because of his government salary, but his investment account was destroyed. And for the rest of his life, Newton forbade anyone from speaking the words South Sea in his presence. But he left us with a quote that every trader should tattoo on their arm. "I can calculate the motions of heavenly bodies, but not the madness of people." The science, the pattern matching trap. Now, it's easy to say Newton got greedy, or that the Mensa Club just had bad luck. But that is a lazy explanation. They failed because their brains were working too well. Newton failed because his brain was a pattern matching machine, and so is yours. This is a phenomenon called apophenia, or pareidolia. For 200,000 years, your brain has evolved to survive by finding patterns in noise. If you are a hunter-gatherer and you hear a rustle in the grass, it's smart to assume it's a lion. If you're wrong, you just got scared. If you're right, you survive. Evolution rewards over-detection. It rewards finding patterns even when they aren't there. In the real world, apophenia saves your life. But in the financial markets, apophenia kills your account. Now, here's the problem with being intelligent. You are better at finding patterns than a stupid person. If you show a random chart to someone who doesn't know anything, they might say, "I don't know, it's just wiggling." But if you show that chart to a smart person, they see a head and shoulders pattern. They see a Fibonacci retracement. They see smart money accumulation. Their intelligence allows them to construct a complex logical narrative, to explain what is essentially noise. And this leads us to the most uncomfortable experiment in finance: the superstitious pigeon. To understand why you draw trend lines on a chart, we don't need to look at a trading desk. We need to look at a box, specifically a Skinner box. In 1948, the psychologist B.F. Skinner ran an experiment that explains almost every bad trade you've ever made. He placed hungry pigeons inside a box, and every 15 seconds, a mechanism would drop a pellet of food. The food delivery system was purely mechanical. It was time-based, and it had absolutely nothing to do with what the bird was doing. But the pigeons didn't understand this randomness. If a bird happened to be bobbing its head when the food dropped, its brain made a connection. Bobbing my head caused the food to appear. So, it bobbed its head again, and eventually, the food dropped again, because 15 seconds had passed. The brain flooded with dopamine, and the pattern was confirmed. Skinner called this superstitious behavior. One bird believed that turning counterclockwise produced the food. Another believed that thrusting its head into the corner made the food appear. They were performing a ritual, convinced they were controlling the outcome. But they were just dancing for a random timer. Now, look at this chart. When you buy a financial asset because the RSI is oversold and the price goes up, you feel like a genius. You feel like you've solved the puzzle. But what if the price went up simply because buyers happened to step in at that moment? What if your indicator is just a pigeon bobbing its head? Intelligence even makes this worse. A smart pigeon, if there is such a thing, would invent a more complex pattern, just like a smart trader invents a more complex system. But complexity doesn't tame randomness, it just masks it. Random walk versus real market. If you don't believe me, if you still think you can distinguish real market structure from noise, let's test it. I have generated 2 charts. One of the charts is a real financial asset, a major US stock, during a specific 6-month period. The other chart is a fake. I used artificial intelligence to flip a digital coin. Heads, the price goes up. Tails, the price goes down. It's a random walk. I want you to look at them closely. Look for the trends. Look for the support levels. Look for the psychology of the buyers and sellers. Pause the video if you need to, and pick the real one. Are you ready? If you pick chart A, you are wrong. And if you pick chart B, you are also wrong. They were both random simulations. I tricked you. But I didn't do it to be mean. I did it to show you how quickly your brain, your high IQ, pattern-seeking brain, invented a narrative. You saw a double bottom on chart A, didn't you? You possibly saw a breakout on chart B, but there were no buyers. There were no sellers. Just a random number generator. This is the random walk hypothesis. It suggests that in the short term, price movements are mathematically indistinguishable from noise. And if that's true, then using your intelligence to analyze the next candle is like trying to use calculus to predict a slot machine. It's a waste of mental energy. So, does this mean trading is impossible? Does this mean that the Mensa Club was right to fail? The answer is no. What this means is they were playing the wrong game. Now, everything I've told you in this video is theory, but theories need to be tested. So, starting February 2nd, we are going to run a live experiment to settle this debate once and for all. Is trading a game of strategy, or is it just probability? I am funding a trading account with $1,000 of my own money, but I am not allowed to make any decisions. I won't use charts, I won't use news, and I won't use my brain. I will only do what you tell me to do. We will be running it on our dedicated Telegram channel where we will post a poll. If the majority votes buy, I buy. If you vote sell, I sell. We are going to crowdsource the trades and pit the wisdom of the crowd against the market. I will risk 1% per trade and zero strategy other than your votes. We will publish the P&L results weekly and monthly and run this experiment all the way till November. Will we blow up the account in a week? Or will the crowd actually outperform the hedge funds? I genuinely don't know. If you want to be part of the data set, if you want to cast your vote and watch this chaos unfold, comment the word interested down below. Leave a comment saying interested, and we will reply with the private link to the experiment channel. To win at trading, you have to stop thinking like a scientist and start thinking like a casino. Think about the pit boss at a blackjack table. When a guy walks up and bets $1,000, does the pit boss panic? Does he try to analyze the player's face? Does he try to predict if the next card is a jack? No, he doesn't care. He knows that on this specific hand, he might lose. He's aware he might lose the next 3 hands. But he also knows that over 10,000 hands, the math guarantees he will win. He doesn't have intelligence, he has an edge. This is the shift. People who are new to trading, especially the smart ones, are obsessed with prediction. They want to know what will happen next so they can be right. Professionals are obsessed with probability. They know they can't predict the future, so they focus on the payout. You don't need to know where the price is going. You just need a setup where, when you were wrong, you lose $1, and when you were right, you make $3. If you have that ratio, you can be wrong 60% of the time. You can be stupid more often than you are smart, and you will still get rich. The Mensa Club failed because they tried to outsmart the market. They tried to be right. And for those who know about the turtle traders, Richard Dennis's students, They succeeded because they didn't care about being right. They just followed the rules of the casino. There is an old saying on Wall Street: the market is the most expensive place to find out who you are. If you come here looking for validation, if you come here to prove how smart you are, the market will destroy you. It will punish your ego until you either quit or you let go of the need to be right. Trading isn't an IQ test, it's a character test. It doesn't ask, how fast can you think? It asks, how well can you handle being wrong? So, if you're struggling, stop trying to learn more tactics. Stop trying to interpret the noise. Be dumb enough to follow a system and smart enough to know that you can't control the outcome. Please, don't forget to hit the like button if you learned something from this video, and subscribe so you don't miss videos like this in the future. Thanks for watching.